In this video, let us see the investment management process. There are 5 steps of the investment management process. Let us see one by one each step. Step 1. Setting investment objectives. The setting of investment objectives begins with an in-depth review of the investment objectives of the individual investors or institutional investors whose funds are handled. Liability-driven objectives. It means seeking cash flow stream that must be made for a specific purpose. Let us now see example. Example of liability-driven objectives. An individual may manage their investments to meet specific a retirement objective or college tuition. No liability-driven objectives. It means not seeking a cash flow stream for a particular purpose but rather is managed to meet a return or risk objective. Example: institutional investor that is not driven by liabilities is a mutual fund. Create a benchmark to evaluate the performance of an asset manager. And a benchmark is a portfolio or index used in the assessment of the results of a portfolio for comparative purposes. Example: benchmarks for stock funds can be the S&P 500 index. In the investment management process, the second major task is the development of policy guidelines to meet the investment objectives. Policy setting starts with the decision on asset allocation. Second step is develop policy guidelines to meet investment objectives. Policy setting starts with the decision on asset allocation. For the decision on asset allocation, you need answers this questions. First, how should the assets of the portfolio be allocated among the major asset classes? What should the mix of portfolio assets like stocks, government bonds, corporate bonds, REITs, ETFs, etc. be? Step 3. Selecting a portfolio strategy. It is selecting a portfolio strategy consistent with the investment objectives and investment policy guidelines of the client or institution. Let us now see active or passive strategies. Step 4. Constructing and monitoring a portfolio. Once a portfolio strategy is selected, the investment manager must select the assets to be included in the portfolio. Steps involved are: collect information and construct regarding realistic and reasonable return expectations and forecasts. With the information collected, construct an efficient portfolio. An efficient portfolio is a portfolio that offers the greatest expected return for a given level of risk or, equivalently, the lowest risk for a given expected return. The investment manager must track the portfolio after a portfolio is established to assess how the risk exposure of the portfolio could have changed given the current market conditions, and the asset information in the portfolio. Costs of transactions impact efficiency. Investment managers must understand the cost of transactions not only when the portfolio is initially constructed, but when the portfolio is rebalanced. Step 5. Measuring and evaluating performance. The measurement and evaluation of investment performance involves two activities. Involves properly calculating the return realized by an investment manager over some time interval, referred determining whether the investment manager added value by outperforming the established benchmark.